Hi everyone, welcome to another of our virtual ILS NYC 2021 event broadcasts. Please visit the event website to see the details of our kind sponsors who help us to put on this event, as well as to view all of the content from the discussions that we've held. So as we look at the development of the insurance-linked securities market, always with one eye to the future, this year we're focusing on defining the next generation of the sector. And very important within this, obviously, is the reinsurance company. And today I'm delighted to be joined by Judy Klugman, Global Co-Head of ILS, and Ed Johnson, Head of ILS Sales EMEA and APAC, both, of course, from Swiss Re Capital Markets. Thank you both for joining me today.
Thank you, Steve. Thanks for having us.
Our pleasure. Thank you.
So for this session, we're going to discuss sort of where the next generation of ILS opportunities will come from, and specifically what is the role of a global reinsurance player like Swiss Re in delivering on this. We'll also touch on Swiss Re's own strategy of bringing ILS capacity into its own capital structure and how that's going to continue to evolve moving forward. So Judy, I'd like to begin with you if that's okay. So perhaps you could just give us a bit of background for our viewers on Swiss Re's activities in ILS and why this is an important marketplace for you.
Sure. Well, thank you. Thank you for having both Ed and I. We're delighted to be part of today's session. And, you know, I can't believe time flies. So I've been at Swiss Re now for over 2 decades. And I joined the broker-dealer subsidiary of Swiss Re Capital Markets, which is sort of an odd, you know, at first you would think that that's an odd combination, a reinsurer having sort of a mini little investment bank as part of it. But Swiss Re has been at the forefront of the development of this asset class in terms of bringing insurance risks into the capital markets. And really, I mean, and this is a story that I'm sure your entire audience is fully well aware of, but really in the aftermath of Hurricane Andrew, there was a significant depletion of capital in both the insurance and reinsurance industries. And so the market, whether it was investment banks, you know, Swiss Re, there was a lot of thought put into how do we find sort of complementary capacity to what exists within the traditional markets. And for Swiss Re, that was especially important because the way that historically reinsurers would hedge themselves is that they would just buy protection from their peers, which didn't make a whole lot of sense to Swiss Re from a credit risk management. So if Swiss Re had bought protection from, let's say, Munich Re for a big California earthquake, well, they were probably going to be impacted as well. And so for Swiss Re, it was really important for them over 2 decades ago when they started the broker-dealer subsidiary to really develop an alternative, an institutional investor asset class that would take insurance, that would take these peak risks. Now, at first, it was natural catastrophe, so peak natural catastrophe risk from the industry. And what was important for Swiss Re, too, as it was developing this, is that it was that we didn't look at this as just something for Swiss Re, or that we looked at things on an individual transaction basis. Because I could tell you that for the first few years, as we did transactions, both for Swiss Re and its clients, that it was prohibitively expensive. So the cost of hedging, as we went through sort of that education phase way back when, you know, I remember when I would start educating investors and I would say that I'm coming from Swiss Re. What? Like, what are you talking about? And I'm here to, you know, I want to introduce cat bonds to you. What bonds? Dog bonds? Cat? Like, so, you know, it's hard for us to believe now that, you know, almost every, whether you're participating in the asset class or not, you're pretty much aware of it, though. And so for Swiss Re, it was very important to think about how do we create a market that would allow investors to think of this as just another flow product. I mean, not to say that we look to the mortgage back, but we looked at, generally speaking, to the broader securitization markets. And what do we do to create something so that it's not this esoteric? And that, you know, what we have always been very evangelical about is the diversifying nature of this risk to a broader fixed income portfolio. And so, you know, we created indices, we have provide liquidity, we put out research, we tried to make this look like any other asset class. And, you know, it took the financial crisis for investors to truly appreciate that diversification benefit. So, you know, I think that that was sort of really over, 10 years ago where this marketplace really took hold. And it became a very useful tool to investors. But more importantly, where we are today, I think it's an equally important tool for sponsors to have a robust, diversified capacity source that, just from a risk perspective, you want to have two sources of capacity that complement each other. It makes sense for the investor and it makes sense for the sponsors. So, we think that this is vitally important. But as we think about it, this is just one aspect of insurance. And, certainly, Ed and I will speak going forward. How do we think what we did on the Nat Cat side, how we created something over the past 2 decades that in essence really almost is flow-like and the demand is, great. How do we now then move that forward into other areas? But we're going to be delighted to talk about that.
Great, thank you, Judy. And it's very interesting about the financial market because obviously the asset class has had a second chance to demonstrate the diversification benefit this or in the last year as well. And at the same time, we're beginning to see people continually embracing ILS as part of their reinsurance program too. So it's certainly
absolutely
gone past those early days of it being just a few players like yourselves involved. So moving on to you, Ed.
Absolutely.
So ILS is now a staple, as we were just saying, of reinsurer risk management and a significant source of capacity. Perhaps you could just talk us through some of the early signs of the market, perhaps sort of getting ready for a new phase of growth, because it certainly looks like we're on the cusp potentially of something right now, certainly from what I'm hearing from both the sponsor and the investor side.
No, that's right, Steve. And I think, as Judy was saying, we've created now a product in cat bonds, which is very widely accepted. It's very easy to transact, and there's a robust market around that, in particular for Nat Cat risks. And we've seen, growth in demand. You were just mentioning there, potentially the events of last year spur even more demand for the asset class. And we've seen, I think over since the financial crisis, as Judy was saying, that in some ways demand has outstripped the supply of cat bonds. So there's more demand from the investor base than could be met by natural catastrophe risks alone, and by the cat bond in particular alone. The cat bond market, by our metrics, is now about $30 billion. It's been around that level for the last 2 or 3 years. But there's more like $100 billion invested into alternative capital strategies. And so where's that gap been made up? It's been made up primarily by some ILS funds, trying to become more like reinsurers and accessing risks directly through collateralized remarkets or retro markets in some instances. And so the market has kind of found structures to make up the gap between the liquid market, the liquid flow market that Judy was talking about, and find ways to invest that excess of demand from the investor base. So as we look to the future, Swiss Re certainly wants to make use of this capital as best as it can. And one important aspect that we think the investor base is taking on now is thinking about how they can access risk more directly. So how can they most efficiently invest that 100 billion of capital? How can they get closer to the risk? How can they invest in, how can they partner with those that have access to the best pools of risk capital that will allow them to grow? And so, and also finding ways to most efficiently manage the capital around the collateral structures. And so one way that Swiss Re is looking about this is to create a fund product. And as you've written about, Swiss Re has recently launched a Nat Cat fund, which we think starts to address some of these things. So it will allow investors to more directly access the big pool of risk and opportunities that Swiss Re has on its balance sheet, and then also have a very efficient capital structure to allow investors to participate alongside Swiss Re in that. And that's just on the Nat Cat side. And, we have Swiss Re, obviously a very big diversified reinsurer. We've got a lot of other lines of business that we're starting to think about how we might look to transact those within the capital markets as well.
Yeah, the development of your core nat cat fund, I think, was an interesting one, and it's just another step in sort of creating new ways to partner with different types of capital, which seems to have been an evolutionary trend, particularly in the last decade of the ILS market. And it's very positive because it's giving investors different entry points and different choice as well, I think. Moving back to you, Judy, obviously the evolution of the market seems to be accelerating again at the moment, perhaps. Do you think it's being driven by an increased need for protection, or is this capital seeking access to the reinsurance returns and just more and more of the institutional investors of the world learning about ILS and learning to appreciate it? And how do you think the evolution is going to continue there as well?
Sure. Well, I think, as Ed just pointed out, there is certainly a overarching demand from institutional global investors for, non-correlating, low correlating assets. And, Swiss Re, at Swiss Re, we're trying to keep up with that demand. And really, as Ed pointed out, our recently launched fund is, certainly reflective of trying to keep up with that demand. But as we also think about it at Swiss Re, as Ed points out, we have a lot of different lines of businesses. But what we've historically done, and Swiss Re also, in all those different lines of businesses, we have transferred our credit and surety risk back, if you remember the Crystal Credit transaction, we've done embedded value of closed blocks of life insurance. So Swiss Re has been very mindful about looking at, our different lines of businesses and how to partner with institutional investors. But historically, and the majority of our activities have really been around helping Swiss Re manage it from a risk management perspective. And so now, as we think about what the balance sheet of the future for a reinsurer of Swiss Re is, that it likely won't be just its, stated equity and debt. And, at Swiss Re, it's very important for us to think about how do we team up, how do we work with our investors for more of a capital relief product. And, what's driving a lot of that are those, unfortunately, those are long tail lines. And so it is fundamentally different from the short tail nat cat line. And so for Swiss Re, it's important for us to think about what is the collateral in these low interest rate environments. What does the collateral solution look like in addition to taking the liability? So, we're very focused right now. We don't have, perfect answers, but we think that where we are right now on the thinking about it on a capital management perspective is sort of where we were 20 years ago on the nat cat side. But at Swiss Re, we're very focused of thinking what are the peak risks, and how can we use alternative capital to help us with those peak risks. And some of our other peak risks take up a lot, are very, very capital intensive. So that's sort of where, it's not to say we're shifting, but we're adding additional focus. So from an evolution standpoint, we're not going to stop doing the nat cat. That's a wonderful tool for Swiss Re and for our clients, as well as for investors. And now it's about including additional tools from a capital management perspective.
And the interesting thing there, I suppose, is that obviously the ILS market, we've discussed, I think, at every one of my conferences, how do you add new types of risk, longer tailed risks and things, but it's been quite a challenging thing for the dedicated fund managers, perhaps,
Right.
who don't have the balance sheet, the depth of capital, the leverage of their own, or the ability
Right.
to give investors maybe liquidity options, but perhaps Swiss Re has a bit more flexibility to structure there.
Well, I think another thing there, Steve, which is important, is plenty of those fund structures are set up with a certain mandate. So for example, they might be focused just on nat cat. They might even have exclusions which say we really can't have terror risk, we really can't have cyber risk. And it's very rare to have a fund which can do both non-life and life risks. Whereas that's actually where, as we get into capital management, that's where Swiss Re would see the most benefit from a capital instrument, is if we could combine different lines of business into one transaction. And Swiss Re's done that before. Earlier in last year, we did a Matterhorn transaction, which included both pandemic and natural catastrophe risk, and Swiss Re did that before in 2012 as well. That's sort of one indication of the type of instrument that we could do, but it's very can be challenging to find the home for that type of investment.
Yeah, interesting.
Right. And I think, and just to follow up on that, Steve and Ed, is, that is why when we also think about who are the end investors, who when we talk about low correlating assets, who does that benefit? And the question is how do we create a product where we can speak about these types of risks with the end investor, which has that broader mandate? But that's part of sort of, the conundrum that we're facing, is how do we reach out to that broader end investor?
Which is all quite exciting, because it takes you back your 2 decades to the start again, doesn't it? Really, your experience in the industry.
Yeah.
Ed, back to you again. So I'm guessing that at least at Swiss Re, you've kind of developed a bit of a thesis around this, about how ILS could be used by the company going forwards. Can you give us a bit of insight into that?
No, that's right. So I think it's become, an increasing part of our capital management strategy to use alternative capital. So Swiss Re's created a unit called Alternative Capital Partners, and we are now part of the group finance function, which I think really indicates where we see this going. Whereas, previously the ILS team was part of the reinsurance division. Now we're sort of part of the group function, thinking about how Swiss Re should capitalize itself. And so as we look forward, we see this not just as risk management, as Judy has said, and risk management primarily for us has meant looking at nat cat risks, but we're thinking about how we can use the relationships we have, the capital which is invested in this marketplace. How can we use that more efficiently on the capital side as well? So we're looking across the business and looking at which part of the business consume lots of capital for Swiss Re, and thinking about how we can construct new products to help Swiss Re manage its capital needs. So not all lines of business will fulfill, will be suitable for that type of transaction, but we're looking for things which are really consuming lots of capital across the balance sheet. So, for example, pandemic is obviously a very topical subject. We've seen that pandemic does not necessarily diversify well even in a very diversified balance sheet. Pandemic risks correlate with asset risk. They correlate potentially with other insurance lines. So if we can find better sources for transferring that pandemic risk, then that can really help Swiss Re on its balance sheet. And also other longer tail lines of business, so types of casualty risk, maybe mortality trend. These lines of business have, especially now in a low interest rate environment, are using up lots of capital on Swiss Re's balance sheet. And so, our thesis is really, how can we find ways to transfer those efficiently for Swiss Re and for the investor base?
It's good to hear. It's a new level of sophistication that's emerging in the marketplace in the last year or so, I think, particularly on the reinsurer side, and how you manage your capital and risk across multiple sources of capacity and things. Judy, when we sort of look forward to how the industry is going to unlock some of these new opportunities, and Swiss Re as well, of course, what do you think the industry needs to do to sort of foster a broader based use of ILS capital within the reinsurance business? What are the key potential stumbling blocks and things that need to be overcome?
I think it's similar. We discussed the 2 decades, but I think back to, how did we initially convince, institutional investors to take, a 1 in 100 year probability that an earthquake was going to, happen in California? Think about it from an investor perspective. They put a price to everything, to every security they own, but they can't price something unless they know how much risk they're taking. And our hallmark has always been that we never expected institutional investors to be underwriters, so to speak. And that's one of the features of catastrophe bonds that's so unique compared to any other asset class out there is that there's a third-party risk assessment, and that there's credible, modeling around how to assess how much risk you're taking so that you can price this security that you're investing in. And so as we think to these other types of lines of businesses, that is, I don't want to say it's a stumbling block, but we have to think about how do we get investors comfortable with the actual risk profile that they're taking, whether it's thinking about other types of modeling firms outside of, the big scientific, nat cat ones, whether it's the Millimans of the world or certainly, RMS, and they're all branching out. But how do we get investors comfortable that the risk that they're taking is rooted in a reality, that it's rational, and that to me is not a stumbling block, but it's something that we have to think about. How do we get them? Because as we put a price, we can only price something if we know how much risk we're taking. So that is very, very important. And then another thing that's important, as we've discussed in this session, is that as we move to different lines of businesses, they're not all going to be these short tail 1-2 year transactions, because in the flow cat bond market, generally speaking, they're 3 to 4 year terms. And so you can manage the collateral very well. But when you go to these longer tail lines of business and you're in this low interest rate environment, your typical collateral solution where you just park, your collateral in treasury money markets funds isn't really going to be a productive use. And so that's also right now something that we very much think about, is how to come up with more efficient collateral structures. Do we need to put it all up? Maybe these aren't going to be flow securities, some of these vehicles, or it's a lot of what Swiss Re is really focused on, is thinking about risk transfer along with sort of collateral structure overlays. How do we sort of make that combination really work? And then really the last thing that we think about is, some of these, not all, but some of them might actually have some correlating risk to the broader financial markets. Certainly, when we transferred in our Crystal credit deal, our credit and surety book, that was credit risk, or, some of the embedded value have asset risk. So I'm not saying that all our different lines will, but there is also the potential. And so, there's a price for everything, and we just need to think about how do we price this. So it's not to say that necessarily going forward that our asset class is always going to be 100% uncorrelated, and that's what, you can bring that to the bank. But that still doesn't mean that there's attractive relative value if investors can understand that risk, and we can think of a good mousetrap for the collateral. But that's what we're thinking about how we move forward from this, to the next phase.
And I assume you're talking to investors about these things, and are you finding investors likely to be receptive to different collateral solutions and also willing to take a bit of correlation?
Yes, absolutely. But, we speak to a very sort of wide, disparate type of investor bases. There are the end pension funds that participate in the asset class. There are the dedicated guys. So there are different pockets of investors for different type of lines or products that we have in mind. So right now, Nat Cat is attractive, or at least the product that is in existence, that 144A cat bond, really appeals to a very wide array. But as we move forward, we do believe that it'll be a little more specialized, and that will sort of gravitate to certain investor bases. Not all. I don't think that all investor bases will be attracted to all the, the different lines of businesses that we think about going forward.
Sure. Which brings to mind, obviously, the age-old graphic that everybody used to show at ILS conferences of the size of institutional assets compared to the insurance industry. And obviously, there's plenty of capital out there. It's just another job of educating all of these investors on a new opportunity, I suppose.
Absolutely.
So Ed, back to you as we begin to sort of come to the end of our discussion. Any thoughts on where all of this could take the industry to, say, a decade further down the line from here?
It's a Well, it's very difficult. I mean, we hope it goes a certain way. You know, we think, as Judy was just saying, I think initially there's going to be a lot of bespoke trades. I think there's going to be a lot of discovering the right investors for different types of risk, different types of structure. And so it will be a learning exercise for both us and for different types of investor base. Hopefully, in 10 years' time, we will have, you know, found those mousetraps, as Judy says. We will have found areas where we can efficiently transfer different types of risk. And so we will have found a good home for pandemic risks. We will have found a good home for mortality trend risk, for casualty risks, and maybe for cyber and terror as well. I mean, all of these risks which are currently sat on, you know, the diversified reinsurance balance sheet. How can we find ways and homes for those risks? So I hope in 10 years we don't know what those products look like yet. Some of them might look like the cat bonds we have today. We might be able to borrow heavily from that technology, but we might have to come up with completely new types of structures. Some investors and product lines might be an over, you know, a negotiated derivative contract, for example. Some might just stay as a more traditional insurance contract between rated carriers. So it's a bit of an unknown. So I can't say exactly what it will look like in 10 years' time, but hopefully we'll have found solutions for different risks that we have, and efficient ways to transfer those.
Great, thank you, Ed. And Judy, perhaps over to you. Maybe a few of your thoughts on what the future product set might look like for the cedent and the investor base, I suppose. And do you think the catastrophe bond is going to remain central to the ILS market? Obviously, it seems to be very popular at the moment again.
Oh, I mean, I think that it's here to stay. So looking at catastrophe bond market, it absolutely, as you know, and I think I said this earlier, it provides a vital tool for both investors as well as for sponsors, diversified capacity source. I mean, it just, you know, you think about reinsurers are in the risk management business. So doesn't it make sense for insurers, reinsurers to have a vibrant, sort of completely uncorrelated capacity source? And it makes sense for investors. You know, we saw that through two true, you know, volatile markets, whether it was the financial crisis or the start of COVID. You know, investors, you know, we can say how great, how diversifying, but it really takes times of stress for it to really be tested, and it proves itself. So, you know, I think that the flow commodity business that exists around cat bonds are a permanent part of sort of the landscape. And as we think going forward, you know, as Ed says, you know, it'll be interesting to see how it develops. You know, maybe part of these longer tail business lines comes into a swap market where you aren't, you know, fully collateralizing, but then as a result, you're dealing with end investors and not, you know, specific fund managers, you know, so it's just, we have a very open mind about how we think the market's going to develop. And, you know, there's a lot of insurance risks to go around to satisfy the demand. And it's really, you know, we've always felt at Swiss Re, it's, you know, our job to help keep pushing this forward so that the capital markets are an economical and efficient both risk management and hopefully capital management tool for sponsors. And, you know, we've been, and I use this word a lot, but we're very evangelical that for an institutional investor, you know, you have to have this as part of, you know, your portfolio. It really is. It, you know, we talk about moving out on the efficient frontier, but you know, investors now fully appreciate that. So we're very, very excited at Swiss Re for what the future holds.
That's great. Thank you very much. It's exciting to hear you both talking so sort of openly about what the future might bring. I think everybody is quite excited about the potential for ILS right now, and it's good to hear that Swiss Re is clearly excited to explore the possibilities too. So Judy, thank you very much. Ed, I really appreciate your time. It was great to have you both with me today. Thanks for the support.
Bye-bye.
Thank you, Steve.